Alright guys, so all aboard the USS Armageddon, we are sailing back into the twilight zone. And let's talk about currencies and the US bond market today. It's a very important conversation because we are still headed towards an eventual debt default. Now, since Trump took office, there's been one overarching desire from the White House, even above reshoring industries. Now, the Dream Team wanted to prevent a blow up of the US national debt, and at the core of that is to reduce deficit spending, which means how much money the US government spends. However, in his recent hearing in Congress, Bessent once again affirmed there's no U-turn possible. The debt tsunami can't be stopped.
The United States government will never default, that we will raise the debt ceiling, and Treasury will not use any gimmicks. We will make sure that the debt ceiling is raised.
Now, I believe Bessent here. 100%, the US government will never default. They will just raise the debt ceiling, they'll borrow more money to pay back bondholders. It won't be a technical default, but a default through inflation. And let's be clear, there's nothing wrong with borrowing money. If you can borrow money at 2%, and if your economy can grow at say 3%, you can outgrow your debt burden. But it's simply not happening in the US economy today. Now, GDP for Q1, as we all know, is negative 0.3%. The economy has contracted. Meanwhile, the latest estimate for Q2 GDP growth is 2.3%, and that's very optimistic using only a week's worth of data. But even if we go with this fantasy scenario, it's not good enough because the rates at which Bessent is borrowing at is unsustainable. Despite the US-China reversal, the market doesn't believe the economy is in the clear. Now, inflation has calmed down, the recent CPI has actually cooled, but investors are bracing for a trifecta of disasters. They are expecting the dollar to continue going lower. At the same time, they realize the US borrowing isn't going to stop. The fallout from the tariffs isn't over yet as well. Now, the 10-year yield has spiked back up and has actually crossed the pivotal 4.5% mark. Realize how crazy this is. Even after the reciprocal tariff debacle in April, rates never broke the 4.5 level, but it just did a day ago. Now, this isn't good. It's a clear sign that the market is not able to absorb the flood of US bond issuance coming from the Treasury. Now, despite the hope of Doge cutting down government spending, there is a big gap between the $2 trillion target and the reality of just 100 billion or so. And that's why currency expert Stephen Jen is warning of an implosion of the entire US bond market, and why it might be the only way to reset the entire system. The US might be facing a Liz Truss moment, which saw the British bond market literally implode. She tried to push through big tax cuts without offsetting reductions in government spending. This is the exact same thing that Trump is trying to do. And please don't buy his argument of tariff revenue saving the day because the amount is nothing compared to the deficit tsunami. And when investors dump their long-term UK bonds, that sent yields higher by more than 150 basis points, a 1.5% rise. Obviously, that would be bad for any economy, but this happening to the US would spell doom for everything from mortgages, from the rates all the way to car notes. But here's where Trump might be trapped. His previous tactic of a tariff pause won't work this time to bring rates down. Everything is on pause, and we even have a reprieve with China today. Now, what investors are really frustrated about is with Trump's tax cuts without a proper spending cut plan. Now, the money will have to come from increased debt issuance. There's simply no other way left. Trump's new tax bill is going to increase the US debt load by at least $3.3 trillion by 2034. That's at least an additional $330 billion a year in additional bond sales for the next decade, which translates to the budget deficit hitting an insane 7% of GDP. Now, it's so bad that investors of US long-term bonds are revolting. They have pushed the 30-year yield to above 5% yesterday. It's a sign that buyers are demanding a higher return because the US debt situation is simply untenable. The endless US spending is now meeting another storm of slower economic growth from the tariff war. Now, what happens when you have more money chasing fewer goods when input costs are going higher? You run the risk of structural inflation even when the economy is slowing down. Now, put yourself in the shoes of foreign investors, and this is a very important exercise to have. Investing in US bonds might not help you beat real inflation. In addition, you've already booked a real loss in your investment. Now, every major currency in the world has appreciated against the dollar. You flip this around, it means the dollar has collapsed across the board. Now, take the biggest investors of US Treasuries. EU investors suffered a 8.3% crash on their dollar debt holdings. For the Brits and Japanese, in local currency terms, they lost at least 6%. And that's why foreign investors they are running away. That's why yields are rising. Global demand is simply drying up. And instead of a real solution like cutting down on deficit spending, we have crazy schemes from Bessent. He's now trying to conjure new ways to boost demand for US assets.
Yes, sir. And also, the digital assets are an important source of innovation that will drive that can drive usage of the U.S. dollar around the world, as with stablecoin legislation. There is speculation that there may be up to $2 trillion of demand over the next few years for U.S. government securities from digital assets.
Now, this is a wild goose chase, but let's play along and assume Bessent is 1000% right. All this money from stable coins, they're going to go into treasuries. Now, a $2 trillion worth of demand for US assets, all going to treasury bonds, will that work? Well, what happens after that? The US government will still be spending nearly $2 trillion a year that can easily absorb that demand. The only real solution is to cut down on spending, thereby reducing the deficit. Because if the bond implosion continues, the Fed will be forced to do the unthinkable. Now, Powell will be forced in to step in because the entire financial system is at risk, and this would mean starting QE once again and buying up US bonds to create artificial demand. Will that save the system? Yes, it would. Bond yields would drop, but that would also destroy the value of the dollar as global confidence collapses. And if you think the previous asset sell-off was bad, just wait until the next one. Trust will be heading into the negative zone. This will screw savers and bondholders. Their purchasing power will get inflated away to save the system. And after the dust settles, asset prices across the board will rise. Not because they gain value, but because the dollar fell against real stuff. Eventually, we'll be heading into a new world, one where the USD becomes weaker, inflation will also stay stickier than before. Hitting back under 2% perpetually is just going to be a fantasy going forward. Now, this sounds like a doomsday scenario, but we are moving closer and closer towards the end game. And just like under Janet Yellen, Bessent is trapped in a situation where he can't stop the moving train. He needs to really cut big ticket items like defense. At the same time, he will need to U-turn on many of the tax cuts centered around reshoring. But can he? He probably can't because of Trump's grand plan. And by 2029, the US debt would exceed the record high of 106%, which means interest payments will continue to increase unless rates drop down. The risk of breakage will worsen. We could get a debt scare every single quarter or even every single month. But what's clear is the US will be forced to choose between maintaining the dollar strength or the entire financial plumbing. You simply can't have both. One will need to be sacrificed. And my guess will be the dollar. The biggest losers will be the bondholders and savers in USD. Won't really be any different this time. So while US investors are risking a dollar collapse, they're getting locked away from a mega China windfall. Now, we mentioned before how China's CATL is about to IPO. We also talk about how onshore US investors will be locked out as well. So most people won't be able to ride onto China's success as their economy grows and their tech dominance grows as well. Now, the company originally wanted to raise $4 billion. Well, there's just so much investor interest that the offering is about to jump to $5.3 billion. That's an incredible amount of investor demand beyond just the retail crowd. Big institutions are backing up CATL, and this includes China's state-owned oil company Sinopec and Kuwait's sovereign wealth fund. Of all the IPOs in 2025, CATL will win by huge margin. $5.3 billion is almost on par with all the US companies on this list. And as we mentioned before, this is going to be a slam dunk. This is how China's EV dominance is spilling over to the financial markets. Realize that Beijing doesn't need Western money to fuel their successful companies anymore, which means a lesser need for the central government to give into Washington for financial deals or for the trade war as well. They can raise money from their own domestic market and the global south, especially Asian money. Do Chinese companies prefer to list in New York? Well, in the past they did, but because of all the regulations and the geopolitical tensions and all the risks from Bessent, it's better to take things local now. There's a reason why investors are bullish. Despite the US blacklisting CATL and tariffs on Chinese EVs hitting over 100%, there's simply no way to replace Chinese batteries. In 2024, nearly 38% of the entire EV battery market comes from this one company. And if we throw in the next biggest company, which is BYD, China dominates over 50% of the entire market, which means there's no way to avoid Chinese batteries, especially when the US is waging a tariff war with global automakers. EV makers around the world looking to ship their exports to the US, they'll be facing a 25% tariff war. It's the exact same playbook as the rest of the tariffs. Batteries in an EV account for 30 to 40% of the total vehicle cost. There's no point in buying batteries from a US or EU company when you obviously need to lower your input costs. Ironically, the tariffs are only going to backfire on Western battery companies. And because China is ring fencing their technology, the difference in cost is only going to accelerate. Now, according to Goldman, battery prices are expected to fall by more than half in the next 5 years. So, electric vehicles are expected to get cheaper over time. But all the components here assume you have access to a flexible supply chain, which only China has, especially in EV metals and rare earths. So this chart is not applicable to all battery companies in the world. CATL won't be short of business for the foreseeable future. So Bessent's plan of getting money into US companies is getting dismantled. The more Chinese companies continue to list in Hong Kong, the more capital will flow away from Wall Street, and this will make the US asset exodus worse in the years to come. And if we compare US stocks versus the rest of the world, the trend is very clear. Since Trump started his trade war, US assets have become decoupled from global stocks. Even after the recent recovery, the S&P is still flat. Global equities are up by 11%, mostly driven by Chinese stocks. As investors, this is the tangible effect of the tariff war. It's only going to get worse unless the US solves their overspending. We'll see more trusts leave the system. More investors will look for alternative assets, and that might be gold or international stocks. Hey, maybe we are all wrong, right? Maybe Bessent is right, and we should never ever bet against the US markets. Perhaps this is one big trap orchestrated by Washington to burn global investors who defy them.
For now, a parting thought. When I entered public service, I spent more than 40 years in the asset management business. There, one mantra guides one of the world's most successful investors: never bet against America. Warren Buffett coined the phrase, and it's been his lodestar as long as he's been in the game.
But let me know what you think. Will US bonds continue imploding? And will China ever list their companies in the US again? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.